Yes, you're on recording.
Thank you. Hello to everyone attending today's webinar, Current State of the Seeding Market. We are delighted you are joining us today. This program has attracted a very large registration flow from numerous industry professionals. Our virtual format has brought attendees from many cities, states, multiple time zones, and countries around the world. Welcome to this Hedge Fund Association webinar. My name is Holly Singer. I serve as Vice President of the Hedge Fund Association. My HFA role focuses on marketing, public relations, and event development. I also run a marketing communications and PR firm. Please note, this HFA webinar is being recorded for the benefit of today's attendees and for those unable to join us today. HFA will share the recording and relevant content slides. Stay tuned. Many thanks to our sponsor, Tannenbaum, Helpern, Syracuse, and Hirschtritt for graciously hosting this webinar. We really appreciate your sponsorship and your involvement with the Hedge Fund Association. Next slide. For anyone not familiar with HFA, here's a brief overview. The Hedge Fund Association is a global nonprofit organization. As a trade association for the alternative investment community, we serve hedge funds, private equity, venture capital, real estate, and wealth management firms, investors, and industry professionals. We are led by volunteers. HFA organizes numerous educational and networking events, educates the media, and provides industry advocacy initiatives. If you are not already a member, please visit HFA online. You can see the URL, hedgefundassoc.org. Please visit us online or stay tuned for our follow-up message after this webinar, which will contain applicable links and price points. Very reasonable. So let's get on with the show. Today, we are very proud to present an excellent speaker roster. We have Caroline Lovelace, Hoerdemann, Michele Itri, Wayne Davis, an excellent speaker roster from seeding allocators and a leading law firm with tremendous insights to offer. All of them will be individually introduced by our moderator, Wayne Davis. Now, let's welcome Wayne. Wayne Davis is partner at Tannenbaum, Helpern, and co-chair of the investment management practice. He serves as a member of the management committee. Wayne advises venture capital, private equity, and hedge funds, as well as family offices. Wayne brings an extensive background on business structuring and formation, governance, seeding, and financing arrangements, as well as implementation of investment strategies. Wayne, please lead the rest of this webinar. Thank you in advance.
Thank you, Holly, and thanks to all at the Hedge Fund Association who helped put this webinar together. I also like to thank Nancy Wu, my firm's marketing director, for working with Holly and assisting with the preparations. Thanks both so much. I'd also like to thank, of course, all of those listening in this morning for taking the time to tune in. We have a very important and particularly timely topic to discuss. And as Holly mentioned, really an outstanding panel of experts with us to share their knowledge. I'm going to start by introducing the other panelists, then talk a bit about the format for today's program, and give a brief overview before we actually get started with the panelists' contributions. With us is Caroline Lovelace. Caroline is founder and managing partner at Rose Hill Park Alternative Asset Managers. Caroline's actively involved in the selection and seeding of emerging managers, and specifically prior to founding Rose Hill, Caroline was a founding partner at Pine Street Alternative Asset Management and co-portfolio manager for a seed fund for emerging managers with a particular focus on women and minority-owned managers. Also with us is Eric Hoerdemann. Eric is partner and chief of research at Stride Capital. During his career, Eric has directed more than $15 billion of investments to external managers, including initial institutional capital, to numerous early stage and emerging managers. The third panelist is Michele Itri. Michele is a partner in Tannenbaum Helpern's tax practice group, focusing specifically on investment management related matters. In addition to Michele's overall expertise with respect to the structuring and formation of private investment funds, Michele has extensive experience advising with respect to seed capital transactions, representing both the seeded funds as well and managers, as well as the seed investors. Just a quick overview of our format. We're going to have the panel discussion followed by an opportunity for questions and answers prior to final notes. We have received certain questions from presumably attendees prior to today's program, but if you have questions during the course of the program, please feel free to submit them through the chat or question and answer function on your screen. I will be checking periodically, and we will do all we can to answer as many questions as we can. The panel discussion will be broken into two parts. First, as Eric referred to it the other day, I'll call it Seed Transactions 101, and perhaps we'll get to even a little bit of 102, where we're going to talk about alternative structures, revenue, equity sharing, first loss arrangements, as well as key terms for negotiation, and talk about the distinctions between seeding a pooled vehicle, a fund, as opposed to a separately managed account. So as far as the topic itself, we all know that capital raising is very often if not the major challenge for emerging and early stage managers. One can have an excellent portfolio management team, a differentiated investment strategy, appropriate infrastructure and quality service providers, but the success of the business will be almost entirely dependent on a successful capital raise. And that's where seed capital can provide so much value. First, of course, it allows for a fund investment sufficient, hopefully, to generate the fees necessary for the manager to operate optimally. In some cases, the seed arrangement can also provide for direct working capital and or operational support for the management firm. It obviously provides an AUM boost necessary to optimize returns and hopefully attract additional investment. And finally, the right seeder can provide a reputational endorsement helpful in attracting further investment. We all know seed capital comes in various shapes and sizes, and that's what we're going to discuss today initially, from the structuring options to critical terms and trends in the marketplace. We're also going to be talking about what's actually going on in the market today. And in particular, we'll of course touch on the pandemic and how the way in which all of us have been operating through it has presented its own unique challenges. Michele, with that, I'm going to ask you to please start with an overview of seed transaction structures and terms.
Thank you, Wayne. So I'll just start with an overview of that. A seed deal is basically an agreement by an investor to provide a substantial mass of capital to an investment fund, generally, typically of an emerging manager, managed by an emerging manager, but oftentimes we do see more later stage managers receiving seed capital as well. And in exchange for that initial early investment, the seeder receives a participation in the manager's business operations, the revenues generated by the manager, as well as certain other beneficial investment terms for its investment in the seeded fund. Now, seed structures can typically take one of two forms. The first, which has become much more popular over the recent years, is a revenue sharing arrangement, which is effectively a contractual arrangement in which the seeder receives a percentage, typically falling in the range of 15 to 25% of the gross or top line revenues generated by the investment manager, as well as of its affiliated entities, including the general partner and its incentive allocation. Now, the seeder in a revenue share arrangement can receive a lower percentage share because it's participating in the manager's gross revenues rather than its net profits after the deduction of expenses in an equity arrangement. And these arrangements are much more straightforward because the seeder is not concerned with measuring the manager's day-to-day expenses because its revenue share is on a gross or top line. So the manager can maintain more independence and more control over its business. However, there are some seeders that take a revenue share approach, but they're willing to bear certain of the manager's expenses or to structure the revenue share to kick in only once the manager has received a certain threshold amount of revenue over the first year or the first 6 months, a certain designated period, to ensure that the manager has enough revenue to cover its operating costs and continue its business. So we do see, I think the majority of revenue share agreements, we do see some kind of modification. It's not a pure gross top line revenue share. Now the seeder in a revenue share arrangement still we do see more and more trying to receive the carried interest or the incentive allocation received by the manager from its fund as a special limited partner participation directly from either the master fund or the US fund or offshore partnership. And this has a tax component. It allows the seeder to receive, if the fund generates long-term capital gain, the seeder can receive long-term capital gain treatment for its participation in the incentive allocation, just as if it was the GP having an equity interest in the GP, but it receives this allocation directly from the fund as a limited partnership interest in the fund. And also this structure avoids having the general partner having deductibility limitations on its payment of a fee to the seeder out of its incentive allocation. And also typically in these arrangements through the contract, the seeder is also entitled to receive a percentage of the net proceeds on a sale or IPO of the manager and general partner of the fund. Now you can compare this, and some seeders do receive, look for equity interests. While this is somewhat fallen out of favor among seeders in recent years, we still see some arrangements where the seeder gets an actual percentage equity interest in the net profits of the investment advisor and the GP, and also a share in the capital proceeds on the sale or IPO of the manager and its affiliate. Now, in these type of arrangements, we do see seeders are more involved in monitoring the manager's expenses and typically look for caps on the principals and employee compensation paid to those persons in order to prevent the seeders to protect its equity interest in these entities. Now we do see that revenue share arrangements are more popular these days, mostly due for especially for US-based seeders, for equity concerns over potential liability issues or increased regulatory scrutiny by the SEC and other regulators, and also for non-US seeders. As more non-US seeders get into the seeding business, there are tax issues resulting from equity interest in US-based investment managers for non-US seeders. And so we do see more and more that seeders are looking to top-line revenue share arrangements. I do want to compare this to another increasingly more popular alternative means for managers to attain a critical mass of capital in their early stage of investment management in first loss capital arrangements. Now these arrangements are in which a platform provider allocates capital to typically a separately managed account for a manager to trade. Typically, these firms often allocate significant amounts of capital ranging from 25 million to 100 million in assets to the account. And the manager is required to also contribute capital to this account as an investor in the fund, the platform fund. And it's generally a fixed percentage ranging from 10 to 20% of the overall total managed account balance. And that percentage depends on the different provider. In exchange, the manager now in this deal with the first loss capital provider, the manager receives a higher than industry normal performance fee, typically up to 50%. And for this higher payout, the manager's capital that it invested in this managed account sits in a first loss position, which means that if there are losses generated by the managed account managed by the manager, the losses are first allocated to the manager's capital until the capital is reduced to zero, and then any remaining losses would get allocated to the platform investment. But the manager, then any subsequent profits, 100% of future profits are allocated to the manager until they're made whole for prior loss allocations. And so effectively, it's a high risk investment for a manager, but they're able to build a higher AUM, to build a track record without essentially giving up a piece of their business or any control over their business to a seed investor. Other benefits include in first loss accounts that they typically pay their performance fees to the managers on a monthly basis. There typically is not a management fee paid to these managers, but they do receive their performance fees on a monthly basis rather than having to wait to the end of the year. So that helps with cash flow, operating cash flow issues. And also typically the platform usually covers the startup and admin costs for the managed account, which is helpful for an emerging manager first getting started. Now, as I said, these type of accounts can be beneficial to new managers because they do provide substantial capital to managers. However, at the outset, however, the manager has to be able and willing to put up the high risk capital investment into the established account. I'll talk briefly a little bit about separately managed accounts versus funds. We do see seeders. I see more common that seeders are putting their capital into a commingled fund, since really the point of the seeder, a big part of the seed arrangement is to get a critical mass in your fund to attract outside investors into the fund who don't want to be the first investors in the fund. But we do see seed capital coming in through managed account arrangements to help the manager start its track record and get started, run a track record for the first couple of years before looking for outside capital. And just in either event, the existing of a seed arrangement, it's important to note, must be disclosed to fund investors in the fund's offering documents. The investors want to know that there's a seeder that is entitled to a piece of the revenues of the manager, and also entitled to certain beneficial investment terms. Now I'll talk a little bit and give you a brief overview of the different negotiable terms that are generally prevalent in seed capital arrangements, because they are all over the place. However, they do typically fall along with certain common ground lines. I'll start first with whether the seeder is going to be required to provide operating support and require operational control or some control or veto rights over the operations of the manager. As there are seeders that can take two different approaches. Whether there are seeders who look to become an active role in the business of the underlying manager, and there are some seeders that want to just take a hands-off, passive role, they negotiate their investment terms into the fund investment, but then really take a back seat on the day-to-day involvement in the management of the manager's business. One type of platform which we've seen that is heavily involved, at least in the outset in the manager's business, are incubators. Incubators are platforms that house managers in their own office space, provide back office support during the manager's startup period, with the goal to help the manager start the fund, start its operations, hire the appropriate people to effectuate a spin out and become operationally independent, but then continue providing the incubator with a continuing revenue share in the business of the investment manager. In addition, there are some seeders that offer managers other types of working capital support to get their business off the ground. As you know, starting investment management business requires a substantial amount of working capital. Seeders not only can offer managers capital for their funds, but they also, some seeders offer working capital support for the management business through whether through their equity ownership and making a capital contribution, or working capital loan, or also we've seen prepayment of management fees on the seeded investment to assist the manager with their early startup costs. And also there are some seeders that will, while there are some that just take a passive role, there are others that look to use their experience and their network to help the business grow of the seeded manager. And they will provide business development support, marketing, risk management, and governance and guidance on the business operations and other issues of the seeded manager. So when you have a seeder that's looking for governance and control rights, and these vary tremendously among seeders, how much control they're looking for, but they see typically the control rights fall in two buckets: control over the manager's operations and control over the fund that they're putting their investment capital in. In terms of manager control rights, seeders may seek voting rights over certain key business and operational decisions of the managers, including risk management processes, certain hiring and firing decisions of key personnel, the issuance of equity in the manager to whether it's personnel or to outside investors, certain other contracts, entering into contracts over specified threshold amounts, the annual budget of the manager, incurrence of debt at the management level, and certain other extraordinary events like the sale or merger or liquidation of the manager's business. On the fund side, the seeder may seek to put restrictions on the manager's portfolio composition for the fund and limit withdrawals from the fund by key persons, and also seek to obtain consent rights over certain changes in the fund service providers. They may also seek to be a voting member or observer on the manager's investment committee. And also for a PE style fund, they may also look to appoint a member to the limited partner advisory committee. Now, in terms of the participation rights over the manager, the terms are very negotiable. Again, they're the typical duration of a revenue share or equity interest vary widely, but typically we see the range of 5 to 10 years. However, some cases, some seeders are looking for their revenue share to last in perpetuity. Sometimes the duration of a seed participation is not marked by years, but marked by a threshold level of AUM. So the manager gets to a certain AUM level, then the seed participation rights can either be, which I'll discuss in a minute, can either be bought out or sunset. Also, the seed participation rights includes participation typically in the management fees, incentive fees, or allocations and other fees received by the manager. So if it's a PE style fund, any type of fees that the manager receives from managing the fund or the underlying portfolio companies, the seeder is going to participate in. And also there are many seeders that negotiate tail economic rights with the key persons effectively to the management company to allow them to receive the same participation rights in any new venture started by the key persons after they leave the manager for a certain period of time. Because the seeder wants to protect its investments, make sure that the key persons don't shut down the management company and then start a new business next door and without them. Now, typically we see, however, some seeders don't like to negotiate up front certain buyback rights, because the managers want to know that there's an end to this investment, that they're not going to be paying the seeder for the rest of their lives 20% of their revenues. And they try to negotiate the right to end the seed arrangement by buying back the seeders of equity interest or revenue rights, typically after a specified period of time, usually like 6, 7, 8 years. And for a purchase price typically based on a purchase price based on a multiple of the manager's average annual payments to the seeder over the prior 2 to 3 years. And multiples we typically see are 4 times, 5 times the revenues. Alternatively, sunset rights can be negotiated in which the seeder's participation rights are not required to be bought out, but they effectively scale down over time or once the manager reaches certain AUM levels. And also we do see arrangements where seeders require a put option that allows the seeder to put the participation rights back to the management company for the same type of fair market value as the buyback rights would be based on after a designated period of time or meeting certain AUM triggers. These depends on these rights really depend on the type of seeder you're talking about, whether it's a family office or a fund of funds, and what their time frame for their investment is. Another term that's often negotiated is the covenants that are required from the key persons of the management company. The typical ones that we see are required are that the key person agrees to devote substantially all their business time and effort to the manager's business, especially in the first couple of years, which are important. They want to make sure that the key persons are focused on the specific management business that is being seeded, and that those key persons retain at least majority ownership control of the management company. They're not giving out the equity, the next day to, several other investors, as well as that they're required to maintain an investment in their fund of their specific dollar or percentage of their net worth, or specific dollar amounts, and or they may require them to reinvest a percentage of the manager's net profits, typically from, I would say, the incentive allocation back into the fund each year. And also, oftentimes, there are going to be non-competes, non-solicits of the clients and the manager's employees, preventing the key person from walking away from the seed deal and taking the investors and employees with them. Now, the last, I'm going to just give you a brief overview of the capital commitments and the terms that are typically also negotiated with seeders. This is the investment terms for the fund seed capital investments. And typically these commitments from seeders range from 10 to 33% of the manager's overall target fund size. And so they're big, big chunks of investments, whether we see 50 million, 100 million. I think typically the range is 100 to 150 million, but it depends on the strategy, depends on the manager. And then typically these investments are locked up. You want to make sure that the seeder is required to keep its investment in the fund for a period of time, usually 2 to 3 years, which provides a new manager a stable asset base to build its business on, provides a stable flow of management fees to pay its costs, as well as to attract outside capital. And seeders often negotiate the right to withdraw, however, during that lockup period on certain designated trigger events. For example, typically adverse performance loss triggers, a decline in performance from fund launch of 15 to 20% is a standard one. There's also standard key person clauses and bad boy events, and breach by the manager of the seed agreement, fund documents, or other investment parameters. Those are typically ways that the seeder can get out during that initial 2 to 3 year lockup period, but still maintain its right to the revenue share. And the seeder will typically pay either they pay reduced management incentive fees on the seed investment, or they'll pay full fees, but then they take their revenue share on the seed capital, but typically not both. They usually do not double dip. Other terms that, favorable investment terms that they're looking for are MFN rights that allow them to receive the most favored investment terms offered to other investors in the fund, as well as they want transparency rights. They need additional information from the fund, as well as from the management company, to verify that the fund is being managed in compliance with the investment guidelines and to calculate their own revenue share. As well as oftentimes they look for capacity rights, whether it's a specific dollar amount or a percentage of the fund's AUM, to allow additional investments in the hedge fund or successor PE funds at the same beneficial terms. And those are typically the terms that we see for fund investments. So Wayne, I'll leave that on to you to talk to pricing levels.
Okay, well, first of all, thank you so much, Michele. Very quickly, a housekeeping matter for all on the line. I see a number of our attendees have asked whether copies of these slides, substantive as they are, will be made available to those registered today, and the answer is yes. There will be an email from the HFA coming following the program, which will include, among other things I'll talk about later, a copy of the slides. So you will have access to the slides following the program. Now, continuing with the program, but staying with structure and terms, Caroline and Eric, can you speak to what either you, your firms, what you're seeing in the market with respect to structures, trends with respect to structures, and specific terms that you'd like to highlight, if any? Caroline?
Sure. I mean, that's incredibly helpful from Michele, because it does really lay out all the kind of typical terms, and I was checking off a lot of the boxes of the sort of things we do. I would say that however, one of the wrinkles that we have is that we do invest through a separately managed account, typically a ticket size of $50 million. However, the difference for us is that that separately managed account, once we fund it, is actually open to investment for any subsequent investor. So in a sense, that separately managed account becomes a commingled fund, but it has all the managed account infrastructure, and we can maintain control through the investment guidelines, control over the assets, as well as full transparency. We do insist on line by line, so each position level transparency, which we'll get directly from the fund administrator on a daily basis. So that's a bit of the difference. I would say we do pay full fees, although the revenue share does attach to that. So in a sense, we get sort of a rebate. But we think it's important to pay full fees to maintain the original fee structure for any subsequent investors. So we don't end up anything most favored nations issues for any investor that wants to come in later that might write a big ticket and want a discount. So that's, I think, is really important. But then, otherwise, we have a buyout after 6 years at predetermined terms.
Oh, just quick, Caroline, a question just came in. I believe it's directed to you in real time.
Okay.
Can you explain how the separate account has other investors commingled? Is it branded as your own vehicle? A question from one of our attendees.
Right. It's actually branded as the manager's vehicle, but it sits on a managed account platform. So obviously, we have to disclose that it is a managed account, and but from the outside, it looks like the manager's own commingled fund. What we found is that actually subsequent investors really like this because one, they have the investment guidelines. I mean, essentially, these investment guidelines that govern the managed account, they're not telling the manager how they invest. They're basically putting on paper how they invest. Their gross net parameters, what their kind of instruments they're allowed to invest in, and so forth. And so investors really like that because, one, if for a seated manager that doesn't have a track record in this entity, it gives investors a lot of comfort. But then there are also the controls around having a managed account infrastructure. So it's branded as the manager's fund, but disclosed that it is a managed account.
Well, thank you. Eric, what are your thoughts on?
Sure. Well, Caroline and I bump into each other quite often in the industry because you see quite a bit of similarities in kind of approach. So I will echo a lot of the same points with regard to structuring of the deals, both for the benefit of the manager and the underlying client. We actually do use a fund structure different than a separate account because we want to, similar to Caroline, we want to put our capital side by side with other investors. But we do have a direct line into daily holdings of the managers that are fed right into our FactSet system for the same reason of basically being side by side with the manager, offering a form of protection for exactly as Caroline said, newer managers that are another set of independent eyes on their portfolio. And quite frankly, this is not only helpful for instilling confidence with other clients, but the managers themselves find it really helpful too. Because we, as seeders, we have a unique position where we, absolutely have skin in the game, right? So both Caroline and I have very concentrated portfolios. We are kind of the ultimate skin in the game. Yet we do have a degree of independence and objectivity. We're able to compare and contrast our seeded partner managers with other managers in the industry, and what they're doing for some perspective. So, these guidelines kind of help managers protect themselves from themselves, if you will. Exactly as Caroline put it, it's not a risk comp. It's just simply here's what we do. Here is what we've learned through the years. For example, and it's going to be different. A value manager is going to be a lot different than a growth manager. A value manager might throw good money after bad, and a growth manager may not, cut a name that has, tremendous momentum that's becoming outsized. So it might be as simple as, we've never historically made money on, a short that's, that has lost more than 20%. So then, okay, let's codify that. Let's institutionalize that, and we're going to be a voice of reason in the heart of the storm. And what better time to stress test that than the COVID crisis, and hopefully not today, based on what's what the market's doing right now. But to have a partner, fighting the good fight, in the trenches with you is incredibly valuable for managers, and goes well beyond the check, which obviously is important, but over time the check becomes less important, and the other kind of partnerships prove to be extremely valuable.
Eric, that you bring up a really important point, because it's for a lot of smaller managers, they sometimes don't have a lot of the resources to do the kind of analysis in terms of performance and risk analytics that a larger manager might be able to. So they don't necessarily have the best intelligence about what the risk factors are in their portfolio, for example, and how those are performing over time. And what we found is having that really detailed line-by-line information allows us to help them really understand, to get out of the weeds a little bit of their portfolio and really understand at the top level what their performance is doing. That makes them a better manager. It also makes it easier and more effective for them to market their funds and discuss how, what their strengths and weaknesses are to potential investors.
And it also inherently, it adds to the time horizon of the startup manager as well. It makes them be able to be longer term investors. There can be some moral hazard of startup managers that they feel that they need to shoot the lights out in order to get recognized. I think most seeders in the marketplace, they have a long lockup. They're a true partner, long-term oriented, and it enables the managers to really think long-term about their business, and which has real tangible impact on their short and medium-term moves. As an example, right now we have a credit manager that we funded about 18 months ago. And the thesis there, the message to the marketplace was, what, if you want to give me $1, give me 30 cents now, hold back the 70 cents until, the stuff hits the fan. It's a distressed high yield manager, this particular manager. And once that happens, we'll tell you, we'll call that capital. And, under normal circumstances, that's not hold over half of the money you were going to give me is not the best, short and medium, call it short-term business proposition. So being partnered, with someone like Caroline or myself, kind of enables managers to think longer term.
And I would say if any of the managers are in the lucky position to be talking to a number of different potential seeders, I would say that's the partnership angle is something that you should really take some time to step back and think about with any partner. And different entities like a traditional seeder like Eric or myself, or a family office that might be doing it on a one-off basis, have different interests in terms of what the partnership is. And I will say, in my previous life, before working for seeders and founding them, I worked for a hedge fund of funds, and we had an unfortunate situation where a fund had been seeded, but these were sort of short-term partners, and we sort of worked with them, but in the end, they really wanted to pull their capital after the 2 years, which would have been in terms of the market and where the fund was, a really difficult point for all the investors. So that's something to really to really think about and talk with your potential partners about.
Wow, thank you. Such valuable information. Thanks both. Now moving away from the concept of structure and terms, again, more boots on the ground as we think back, perhaps, or I'll ask you to talk about third, fourth quarter 2019, first, second, third, fourth quarter 2020. Caroline, Eric, what are you seeing and thinking about? What's attracting your interest? And given the time, I'm going to conflate a couple of questions I had and try to incorporate generally some of the questions I'm seeing coming up from our attendees. Particular strategies, hot strategies that referred to before, ESG, emerging markets, perhaps. And size, what size is most attractive? Is there a size that just frankly is too small? What do you look for? What are the do's and don'ts from a fund or manager looking to attract you or other seed capital providers? What's a great thing to do and what's something to avoid?
Sure. Definitely a lot there. I'll take a couple. From a size perspective, I think one of the real advantages of working with a boutique seeder, like the two folks you have on the line today, is it really, everyone's going to say this, right? No one's going to say it's about, the size comes first, and but we kind of smaller boutiques can truly be extremely focused on the performance. They can invest and they can invest in managers with a smaller capacity of even sub $1 billion, which is which would be more difficult to do with kind of larger 10,000-pound gorillas that want to grow multi-billion dollar firms. And I'm a believer that, all else being equal, size, is very often the enemy of performance. So having a long-term oriented manager or long-term oriented manager partner with a long-term oriented seeder enables a strategy that that can be smaller than typical. With that said, it's hard for us to go below, say, 200 or 300 in total capacity, because there has to be some element of potential growth. In terms of the current environment, COVID and the opportunity set is obviously a very big topic that we could easily spend an hour alone on, on that alone. But I think that this market unrest, as difficult as it's been, similar to 2008, presents a tremendous opportunity, classic Schumpeter creative destruction, for changing of regimes, unearthing, of new opportunities. The last several years dominated by momentum, passive investing, and the FANGs, has been, a difficult environment for active management and really for smaller managers. So I'm a believer that, again, as painful as this current environment is, it's really going to open up a lot of opportunities for emerging managers, not dissimilar from what we saw in 2008. Stride Capital was actually formed following the 2008 crisis to capture the opportunity set that the great financial crisis presented.
Yeah, I would agree with a lot of that, and I would take it one step further. And yes, both of us are I like that term, boutique seeders, because there is a differentiation in the market between sort of smaller ticket sizes versus very large ticket sizes, and the economics are different. I mean, with a smaller ticket size, what we do is focus on niche managers in good times and bad. So we're not looking for the manager that's going to get to $5 billion. We're looking for strategies that can perform well in times of turbulence like today, but as well, it can take advantage of smaller opportunities where larger managers can't go. And that may be in particular in long-short equity sector funds and they can have a fairly narrow opportunity set. And we can do that in credit as well. We're looking right now at a credit manager that only looks at technology companies. So it's a very, we can go in places where sort of larger managers can't, larger seeders can. And the way the economics work, I mean, with a smaller ticket size, the return to Rosehill Park's investors is more dependent. That IRR is more dependent upon the underlying returns of the manager, less so on how much AUM they raise in a short period of time. The larger the ticket, the manager has to raise a lot of capital very quickly. I think that takes by focusing on a niche manager, niche strategy with a smaller ticket size, that takes some of the pressure off of fundraising in the current marketplace. And I think that's really important to be able to support an emerging manager in that way.
No, that's all incredibly helpful. Caroline, with respect to, at a granular level, if you will, underlying manager sort of do's and don'ts, do you have any sort of tips, if you could, things you've seen that have really sort of turned you off with respect to a presentation or approach, and perhaps certain things that you found particularly attractive?
Well, certainly we're looking for partners. We want to be in a transaction with an underlying manager for a long time. So the willingness to listen, the willingness to, we don't want to tell you how to invest. If we invest with a manager, then we have a very high degree of confidence in their talent. But we think we know a bit better about how to access the best service providers, who they are. Thinking about structures, thinking about the business. We're not going to be involved in your day-to-day, but we want to have a partnership with that manager and someone who comes in with sort of an attitude of you just give us the money and leave us alone. It's probably not the right partnership for us. I would say do's and don'ts. I mean, be prepared. I mean, I think it's great for everyone who's interested in striking out of their own or looking for seed capital for them to be on a call like this, because you want to be prepared. When one of the biggest mistakes is when a manager is not prepared for the due diligence process, hasn't really thought about who are the best references and really made sure those are the best references, where they are, when I think about what they're going to say. Being willing to disclose any issues and background or whatever is important. That establishes trust. And another big one is how are you going to prove your track record? There are some people who can just give you a sheet of paper with an audited track record. You've got all the numbers, but a lot of people don't. But that doesn't mean that you can't prove your track record. Maybe that is through references. Maybe that is through other kinds of portfolio information. Those are, I think, those are some of the things that have been helpful in terms of both establishing trust and then moving forward with through the diligence process at a good pace. Because once you slow down, it's hard. It becomes hard.
And with respect to track records, kind of I would say a tangible piece of advice for this current environment is think about, stress testing your portfolio and compare and contrast versus 2008. And, this is kind of the ultimate laboratory that we're going through right now, of some, pretty violent market gyrations. So be very, very tight on what exactly your thinking was, and what decisions you made and why. And my next piece of advice I'm a little hesitant to give because this is definitely my strong bias, but I love managers that are constantly keeping in mind the devil's advocate and the downside of the disconfirming evidence of their points of view. Folks that think in distributions, Annie Duke thinking in bets, and when they pitch along, they tell you here are the 5 things that won't work. There are the 5 things that I'm looking at, but here are the 10 things that I think will work, and I think it has this probability. The real pet peeve of mine is when folks think in absolutes and in hyperbole. Or when another pet peeve is when folks derive too much out of a very short period of time. We all know, I'm sure everyone on this call has been doing this long enough to realize that when things are going really, really well, we're not nearly as smart as it seems we are. And when things are going really, really bad, we're not nearly as dumb as it seems we are. So kind of thinking in that critical, probability-oriented space would be my real advice.
Oh. Well, thanks. Just looking at some of the questions that are coming in, and we are going to keep this to an hour, so I know now we're not going to be getting to everyone's question. One of the attendees has asked a question. I'm curious to know your views on Eric and Caroline, and the importance of cap intro teams at large banks. And to me, that's sort of the delivery chain, if you will. The means of communicating, the means of contacting, making a touch point and an introduction. Yeah. What are your thoughts on that?
For me, it's a little bit of a mixed bag. I think I think a lot of folks that are seeders pride themselves in unearthing that hidden gem, that manager that few people have heard about, that aren't necessarily in the public domain, and probably more importantly, one that came through an intimate network of individuals that they scuttlebutt with. So all else being equal, I think a warm introduction from a close contact can be best. But with that said, there are some groups out there that do a really, really nice job of combing the universe and are really focused on early stage managers. And I won't name names, but there are a handful of groups. There are 2 or 3 that are really, really good. And when they, when we get incomings from them, I'm always reading it. I'm always reading it right away because they're really focused on small managers. They're long-term oriented. They're not just focused on who can grow the fastest in the shortest, the largest in the shortest period of time, but are thinking critically about about the long-term relationship as well. So I guess for me, my recommendation would be, multifaceted to try to go on LinkedIn, try to find a warm introduction, but also utilize the prime brokers and cap intro as well.
Yeah, I would agree with that. I mean, cap intro is a really important source of new managers, and there are a few who have really made it their focus to find emerging managers, new managers, niche managers, new strategies, and they work really hard at that, and they do a really good job of really trying to match the emerging manager with appropriate capital. So I think cap intro is a really important source, but it's just one source. I mean, I think, yes, the warm intro is really helpful. I found that some of the we all get inundated with kind of newsletters and all sorts of other sites of sorts of industry news, I've found that that's a one way to find the people mover part of some of the newsletters can really be an interesting source of new managers, but of leads. But in the best source is really other managers. They know who the good investors are in their space. They know who the good investors are, even in other strategies. So developing a broad relationships with managers that are that we're not invested in, even though we're not invested in them, and asking them, so who are you seeing that's really good? Who are you seeing that might want to have an early conversation about making the leap in 6 months or 12 months?
A really good point.
Well, thank you both. Listen, we're moving to the next and close to final stage. Just some final takeaways from each of our speakers today. Caroline, we'll go in reverse order. If you want to lend your wisdom, that'd be great.
Sure. I think my takeaway would be around developing relationships and really substantive ones. There was a quote I had from a friend of mine who was at a public pension plan about a mutual friend of ours who said, I really like the guy, but every time I see him, he's selling. We can never just have a conversation. And I would say that should be important, is to with potential investors, with partners, try to have a conversation. That they have an investor has a particular interest in X sector or the X kind of trade theme. If you have something in your book, or you have something that you've been thinking about that's in that area, like have that conversation with them, as opposed to always thinking about your elevator pitch, because those are the sort of things, particularly this environment where we don't have as many face-to-face touch points at conferences and so forth. Trying to make the most of the touch points you do have to develop a substantive relationship, to kind of say, well, this is how I would be as a partner, and so you should be looking at me as a partner, not just as a trade.
Thanks.
My advice would be to really take advantage of this environment. It's the perfect period to really prove your passion, your grit, and resilience through a difficult period. Incredibly competitive out there, as we all know. The rewards are high. And if you can prove and show and demonstrate your passion for what you're doing, I think that'll go a really long way. There's all too frequently, a tension between the asset management business and asset management itself. And I always love that manager that is going to start their fund. They're going to run their own money, run their friends and family money, irrespective if other folks join. Hopefully other clients, investors come along for the ride, but they're extremely passionate. They're very specific in terms of the alpha source, the opportunity that they're looking to exploit, and they're going to see it through. And again, what we're living through right now, is a fantastic laboratory. It's a concentrated, focused test of one's investment skills. It's quite timely. See the silver lining of this otherwise terrible time.
Thank you. Michele?
Yeah. So I'll just leave with just some thoughts about any manager thinking about a seed deal should first be aware of the current market terms for seed deals and how much support, and just think about how much support that the manager will need from a seeder for its business, and what, if any, economic and control rights over its funds and management business it's prepared to give up. Because as was discussed today, there's a wide spectrum of structures and terms that exist currently in the market for seed deals, and knowing upfront what a manager is prepared to live with is really crucial to creating a successful partnership with your seeder. And I'd also want to just leave with, I know we talked in the beginning about seed deals versus first loss capital. And I just want to offer, we do have a client that they're not mutually exclusive. We have a client that ended up doing both. They started out with first loss capital to create a massive capital and start a track record, and then ended up finding a seed investor and negotiate a revenue share arrangement, and really is doing well. So you just need to think about really what you're prepared to give up, and what type of strategy would or structure would work best for your business, thinking long term and creating a long-term relationship.
Yeah. Thanks, Michele. My view is just a few things. I'm going to follow directly on what Michele said. One, with respect to a mutual exclusivity, not just first loss revenue share, but structurally too. I know we've worked in many cases with clients looking to be seeded where the market was such that what was negotiated was a seed into a separately managed account, but with a full view toward transitioning that to a fund investment within a certain period of time if certain performance was shown, and the nature of the proposed fund investment was in large part negotiated from the outset. So keep that in mind, and that really dovetails with my takeaway. And it was a phrase that Caroline used, and that is be prepared to know what you're looking for. But as with any communication, know your audience, and the audience is different. Caroline, as she described, the structure she's working with is very different from an institutional investor or a straight fund investor, different again from a family office. And the one thing I will say, perhaps known to many, is that the family offices have become active in this space as well. We've seen a lot of activity there too. So with that, a couple of points. One, a lot of questions came in that we weren't able to get to. So what I am going, and some of those questions, I believe were referred to specific speakers with respect to structures that were discussed. I encourage you to reach out to the speakers today, whether it be Caroline, Eric, Michele, or me. Our email addresses are included with our bios and slides, so hopefully this could be something of an ongoing dialogue. With that, thank you everyone for attending. Thank you again, Holly, Nancy, Caroline, Eric, Michele. Following the program, there will be an email coming to all attendees from the HFA. It will include a link to these materials, so you'll see you'll have all the slides. There'll also be a link to an audio replay of today's program, so you'll have that to listen to again if you wish. So thank you everyone for attending. Everyone stay well, and we'll talk again soon. Take care.